afternoon, everyone. I'm Pamela Hastings, Relationship Manager here at Barometer Capital. And today we have a very special edition of Barometer Readings webcast. We have joining us today, Diana Avidar, our Head of Trading, and James Callahan, Barometer's Associate Portfolio Manager. They're both joining us from Barometer's trading desk. And on today's webcast, we are gonna have Diana and James articulate what's going on in this macro environment. And of course, at the tail end of the conversation, we would be pleased to address your questions. So don't be shy. You can hit me up on the chat via Zoom, or you can send me an email, phastings@barometercapital.ca. And on that note, and on this beautiful August afternoon, I turn the conversation over to Diana Avidar. Hi, Diana. Thanks so much for joining us. We're really pleased to have you here. And of course,
Pam, how are you? Nice to see you.
We're great. We're thrilled to have your input, and of course, love to hear your views from the trading desk. Diana, what's going on in the market?
Thank you very much, Pam. And with that, let me welcome everybody and thank everybody for joining me on this Tuesday afternoon. It's the dog days of summer. Volumes in the market have gotten to be a little light as you have a lot of out of office replies when you send an email, as many people do like to take vacation at this time. But we're not like the French that take out the whole month out. So here we are watching markets and doing an update. And I also want to thank James Callahan that he's joining our webcast today. He is our associate PM and analyst extraordinaire, which I'm sure you've heard from before. You can also see him on BNN these days now. So he's going to walk us through the thinking behind some of the recent portfolio changes that we've done. We've been pretty constant in our portfolio for a very long time. Turnover has been pretty low, but we have made some changes over the last couple of weeks as we've seen some development in the market. I will start with a conclusion because that's what I always like to hear first when I listen to a presentation. So here's the conclusion. At the core, we think the macro data is supportive. The recent softness that we're seeing in the market, for those of us that are watching closely, is just the market's way of pricing in rates higher for longer, resulting from supportive macro data. Commodities have stopped going down, and we have seen some rotation into them, including ourselves. And the worries about China are probably slowly being priced in and perhaps behind us from a market perspective. As I always say, market is a forward-looking pricing mechanism. And when we find out the problems, it usually explains why the market has already done what it has done. So let us begin with a little bit of pictures, as it's easier to talk through and show you some of the things that we find and I look at very closely as we try to figure out what comes next. I want to start with the macro environment because it's at the top of mind of everybody. Will there or will there not be a recession? Some people think absolutely. Some people are saying it's going to be a soft landing. And others like Goldman Sachs actually came out with a report on Monday saying that, no, we don't need a recession in order to tame inflation. And it's possible they only put a 20% probability because we don't deal in absolute values in the market. We deal in probabilities. They've only put a 20% probability that there's going to be a recession. And if there is one, that we hope it'll be short and shallow. And the reason for some of the optimism and the reason why the market has done what it has done in the US, we'll talk about the TSX a little later, as it has kind of not held up as well. But the reason the market has done a little bit better in the US is because it has been forward pricing in, as we say, it's a pricing mechanism, pricing in situation that was not expected. If I asked you in the beginning of the year, what's the market going to do at the time of one of the fastest rate hike in recent memory, you would say for sure market was going to go down because rates have gone up so much and people are going to be hurt and it's not going to work, but it did. So why? And that's why we're watching the macro environment so much. So what happened is, this is a chart of continued labor market rebalancing So this chart, what it means is that there were a lot of job openings relative to people looking in the beginning of the year, and a very high turnover rate, which was a reflection of a very tight labor market where people felt comfortable quitting because they knew they could get another job very quickly. The Fed didn't like that. Wages were being pushed upward. It's not that the Fed wants to induce unemployment. No, they just wanted a better balance, and they are getting it now. This is resulting in wage growth that is more moderate. And let's not mistake the importance of this. As long as people are working, people can pay their mortgages and housing prices hold their levels. And 30-year mortgage rates in the US have gotten to be pretty high. But they're locked in at lower rates. And so therefore, there is no supply of housing, which keeps the level of the prices at a high level. So we haven't had a big housing sell-off in the pricing as of yet. So as long as people are working, like I said, they can pay their mortgage and housing prices hold their levels. And in Canada in particular, there are areas of great growth, such as, for example, Hamilton, that are growing and building and prices are still reasonable. As a matter of fact, we are doing a real estate LP in Hamilton. If anyone is interested in hearing about this, please contact us. The unemployment rate, this is the chart that shows where we are, is still very, very low. Labor market has undergone, I think, a fundamental shift during COVID. And when I'll mention this, you will nod your head probably and say, yes, I've heard that from people. Many people rethought their careers and retirement paths. And people suddenly realized that, hey, they can retire now, live on less, or live differently or more simply. And so the labor market has been pretty tight, and some people actually did not come back to the labor market. So no matter how high they're raising rates, the labor market unemployment has kept its very low level. From an inflation perspective, this has been the trigger, of course, when unemployment was over 9%. And like you can see at the chart, how much we have come down. As a matter of fact, we're probably slightly ahead of schedule. What that means is that it's probably come down faster than expected, and that kind of tells us that central banks are probably done. Maybe the US faster than Canada, as we had a pretty hot Canadian CPI, and the Bank of Canada probably has another 1 or 2 rate hikes in it. However, we are in a bit of a different situation. Rates are lower than in the US, as our fiscal situation is a little different. Yes, there's debt everywhere, but I think that they're going to stop. Traditionally, Canadian rates were higher than the US rates, but they're not so for a long time now. And I think Bank of Canada is going to stop before Canadian rates go above the US ones. So this has been Canadian CPI. This does not include today's data, which probably would have been a little bit of an uptick, but you can see how much we have come down. So, the very high inflation has come down. You keep hearing about this 2% elusive target. That is something the officials are never going to change. But what is the significance of 2%? Nothing. It really is an arbitrary number. And we're navigating this over 9% to down 3.5%, 4%. Market has liked it. Not only that, but it points to a job well done by the central bankers. And we think that they're pretty much done for now. Like I said, as a matter of fact, Goldman put out this report on Monday about the probability of a recession at 20%. But they also said that they think that central banks are going to start cutting rates at the second or third quarter of 2024. The macro environment, this is the Canadian unemployment, that in Canada, this has also come down substantially and is not, there's no major problem in the labor market. Some months we get better numbers, some months we get worse numbers, but by and large, the unemployment rate is also very low. We have a robust labor situation. And again, this is the all-important metric, and why we haven't gone into a negative GDP environment is that as long as people have jobs, they can pay their mortgages and whatever other expenses they have. and housing has remained incredibly robust due to a very high immigration rate that we have here in Canada. I'm mentioning this as China. China is a bit of an issue. I'm highlighting this here not because we have any exposure to China in the portfolios, but because this directly plays into why the TSX has been such a laggard. Their delayed reopening has been very disappointed. Their property overinvestment and their resultant shadow banking sector is now paying the price, and China will have to come up with ways to handle this. Rate cuts and expansionary policies are probably coming. As a matter of fact, we've seen a small rate cut in China overnight tonight. And, also the world is a lot less correlated to China. In the US, for example, Chinese imports are down to 13% in the first 6 months of the year, the lowest since 2003. The peak was nearly 27% in 2017. But Trump's tariffs have not been reversed by Biden, and the geopolitical framework is not helpful, and the cost to produce in China is not as low, not to mention the political and economic risk environment has also changed. Anybody has seen Jack Ma lately, for example. So, is the market expensive? It's something that people always ask. And, here is a chart just putting it in context where we are. So we are at about, in between the green and the orange line, between 18 to 20 times. And, since 2017, historically, it's kind of in the middle, maybe a little bit more than it has been in 17, 18, 19, but definitely I wouldn't say that it's as a collective very, very high or overpriced. And I'm not talking about stocks like, Nvidia or Tesla or stocks like that. When you look at that, that is a different story. So market is a forward-looking pricing mechanism. So it matters what the revisions are, because that is what the market prices in, is what the collective thinks that earnings are going to be. And this is the earnings expectations going down over 2022, even before 22. And this is perfect proof that the market forward prices things in pretty quickly. And this is what 2022 was, and this is why we had such a big sell-off, because earnings have come down quite substantially. Companies had margin issues, they had supply bottleneck problems, and pricing had to be pushed up. But now estimates are going up. The earnings season so far was earnings were down 4%, but minus 9% was expected. So it was better than expected. And it's always the marginal change that matters, and earnings expectations revision threat is going up. So as a matter of fact, one of the components that is mostly driving this is the expectations that margins are going to be better. And when you think about it from at the gut level, we had supply chain issues in the beginning of 2022. Then we have inflation, so pricing goes up. But the supply bottlenecks have come down, and pricing, once it's up, it's very sticky. It doesn't come down as fast. Companies are not naturally wanting to cut their pricing back in half. They like the higher prices, especially if their input costs come down. And so you have a betterment in margins, actually. So as you're thinking about the world, and you're thinking about recession, and you're thinking about all these negative headlines out of China and inflation and rate hikes and housing, some companies are really able to increase margins in this kind of environment, not to mention that the stock market is a better hedge for inflation than is the bond market. This is the yield curve. The yield curve is in Canada and the US. What you're seeing is the short end here reflecting the rate hikes that we've seen. So very, very high short-term rates, but offset by, the decent macro in the form of, decent savings that people have in a good labor market situation. The belly of the curve, this is week over week. In both countries, you have seen it move up a little bit, and this contributes to the softness that we've seen over the short term in the market, as the market's pricing in a higher level of rates because of a high class problem, because of the economic numbers have come in better than expected. So rates are expected now to be higher for longer. And, and by the way, higher rates are better than zero in many ways. For many people and many businesses, it rewards savers. It balances the risk and pays those that need a steady income, like seniors. It takes out the people that should not be in high risk markets like equity, or the heavyweight in equities, as people do need to create income out of their savings, and now they can get a well balanced portfolio. And from a corporate perspective, higher rates do differentiate between good and bad projects at the corporate level. So zero rates was nice, but not efficient. And then, we look at the measure of fear. There is an index, a mathematical calculation of stock moves in the aggregate. It's called the VIX. This is a chart of the VIX. And we call this a measure of fear because the higher the volatility in the market or at the stock level, and then you put it in the aggregate calculation, the more volatility you expect, the more it costs to get exposure to that stock or index. And when it's really low, the opposite is true. So the market is a bit complacent here. And to be frank, actually, we think it's a bit too complacent, which we are aware of, watching, and we're managing for this. So the VIX is a little bit too low. You can see how high it has been when COVID hit and throughout that whole period. And I don't have it back to 2000, the great financial crisis in 2008-7, but it was higher than actually 80. I think it hit 100. Where we are now, this is the S&P, and we have come in a little bit over the month of July and August. Like I said, we're pricing in China news. We're pricing in higher rates for longer, and the market was a little bit overbaked. Volatility, VIX measure of fear is a little too complacent, and we're also going into some seasonality here. So we are watchful of this and managing portfolios for this. A slowdown, a check back, doesn't have to build into another bear market, but we are watchful, and we want to see where markets go from here. The TSX, I said that we mentioned the TSX a little later, and here we are. The TSX has really not participated this whole year, and as a matter of fact, it was pretty treacherous. Rally, sell off, rally, sell off, rally, sell off. That's very hard to manage portfolios in a situation like this, because every time it rallies, you think it's going to go and you don't know where it's going to stop, and it literally has done absolutely nothing. And the TSX is a treacherous little index in that it's very heavily weighed into two major sectors: commodities, also materials, and then financials. And that's basically the success or lack of it basically drives the whole index. And China, I mentioned problems with China. This is the Chinese index. This really plays into this because China is a problem for the TSX, because China is a commodity consumer, the largest market. We also had the Russian-Ukraine situation, which the world kind of thought commodities rallied in the beginning, and this is kind of what you saw. What you saw here, the commodity rally has taken the TSX back up. But then, there's enough supply out there, and Russia probably supplied China market with cheaper oil as the embargoes were happening. So Chinese market, the reopening, like I said, did not work. And so the commodity demand that is so important for the TSX did not materialize. And this is the TSX sector weight. So, energy being 18% of the index, relative to look at the US is at 5.2. In the materials, so 18 plus 12 is 30. So a third of the market has to be exposed to a robust commodity market, and not just after an initial rally after the Russia-Ukraine beginning, then it did not materialize due to supply, shadow supply, and all kinds of stuff like that. The things that did work, like information technology, is not to be found in the TSX, but mostly in the US. And so that's why you have this huge differential between one market to the next. However, in the US, up until a couple of months ago, it was only the technology sector and 6 to 8 stocks that have had the most outsized move in the index. So if you did not have 10% Apple, you were underweight and did not benefit from the absolute max return because the breadth was very, very narrow. So what are the risks from our perspective? And as we think about the portfolios, the high inflation, high unemployment, and long growth. This would be the long term. What I've shown in the macro pictures and the unemployment and CPI and what we talked about housing, that is not our base case right now. Inflation is coming down, employment is holding, and growth is still there. We have not seen GDPs that would be worrisome as of yet, and perhaps we will have a soft landing. We will see. The second risk from a portfolio perspective over short term is overextended investors. I do talk a lot about flows, and I am not showing any flow charts here because it's August and volumes are really low. So I don't want to mislead with information that may not be relevant in a low market environment. But we have seen flows coming out of the winners and into the commodity sectors, and we have dipped our toes into that trade as well. But I will show you some extension in the next charts. And then there is seasonality. Seasonality doesn't favor August and September. So in terms of overextended investors, I thought I'd talk about the collective margin exposure. This is what happened to margin. This is debt as it relates to stock market on a collective basis, margin accounts, securities margin accounts. And you see 2022 is really killed that trade. Nobody was trading on margin. As a matter of fact, people lost a lot of money, and that actually played in a lot of talk about tax revenues as people lost money. This is U.S. data. As people lost money in the market, they weren't paying taxes on it, and so tax revenues have come down a little bit. But this year we have seen that come back up. This is in the short term, and maybe it's a bit too fast, too much. So there is some room for a little check back here. But longer term, this is the absolute value of collective margin exposure. We're nowhere near where it kind of rallied into throughout the COVID and then the sell-off subsequently, and now it's just a little uptick higher. So longer term, it's not so much. Shorter term, this can balance out a little bit. And as we go into seasonality, we see September is not so great. These two things, the margin exposure coming down, so maybe people pull in their horns a little bit. And Goldman Sachs Prime Book has said that the last month has been a lot of short covering, and now they're seeing some shorts being put back on. Again, this is a very low volume environment, so we'll see what matters. The bottom line, I'm back to the conclusion, is that macro data is supportive of a soft landing and a recession that is short and manageable, and this is what everybody would love to see. I'm thinking China market is getting priced into the market as we speak, and that they're going to start being more expansionary. Commodities have stopped going down, and we have rotation from winners into the commodity moves. Sometimes you see moves and some sector sniffs something out. Maybe it's related to China weakness that is getting priced into the market. And given the narrow breadth for so long, this has been a stock picker market. So even some sectors that have not worked have had some winners, but we do stay away from the underperforming sectors. We have very little utilities or anything that doesn't benefit from a higher rate environment. And with that, I would like to just touch a little bit before James comes on the characteristics of our portfolios. I'd just like to say that it's one of the more diversified portfolios that we've had. Our history is that when we see something really stand out, we are of the temperament to overweight and overweight hard. We've also been in very high cash levels when the market was at risk. So being as equally diversified as now is a function of the market and the risk in the market, and whether it checks back a little bit, and maybe the beginning of rotation. We don't want to sell down our technology, which because of the way it rallied, we have NVIDIA as our top holding, but it didn't start out that way. It's just because of the P&L, the way it rallied, that it was made into a top holding. And so a lot of our tech weightings are top holdings, and we have been taking some profits in them. And James will talk about that. But we're very diversified exposures in technology, energy. We've increased that as of late. Industrials, healthcare. We've had some great wins in healthcare, and there's some great things going on there. And we're mindful of the seasonal weakness. So we're very, very disciplined with our stop levels. We'll violently watch every stock that's not acting as it should, and have a very deep discussion as to what we need to do about that and punt it if that's the case. So turnover has been generally low, but we have made some changes in the portfolios in the past month. So I'm happy to actually bring on James Callahan. He will walk you through some of the changes. Hi, James. Thanks for joining me.
Hi, Diana. Thank you. And thank you for the glowing introduction earlier. So I'll talk through some of the specific changes we've made to the portfolios over the last week or so. And then I'll get into a discussion on some of the GLP-1 receptor agonist drugs that I'm sure many on the call have heard much about. These are drugs like Ozempic. So it's a theme that we've been involved in for some time now. So I'll just give some more specific color later on. So in terms of specific positioning changes, as Diana mentioned, our tech weight has grown to be quite large. So this time, about a month ago, we were sitting with across the firm about 26% weight in technology. Right now, we're sitting at about 17%. So we've taken significant profits out of that sector. Last week, we trimmed some NVIDIA where it had grown based on the positive performance to become an outsized position in many portfolios. We trimmed that back slightly. We also sold last week AMD to lighten up on some of the semiconductor exposures. It's our view now that AMD is a more distant second to NVIDIA in terms of AI exposure now. We sold Salesforce. That was a name where the thesis had been they were taking substantial costs out of the business. We think largely that's behind them now. So we took some profits there. And then OpenText in Canada reported a pretty disappointing quarter. So we moved on there just based on the chart. And we used those proceeds to fund some purchases in the financial sector, specifically the insurance industry, which we've been a fan of year to date. So we've added some Sun Life in many accounts. And then in the commodity space and energy specifically, we've added some ARC Resources and Tourmaline to get exposure to gas. And then we've added some Hess where it makes sense for some oil exposure. Because in regards to those commodities, it is a supply issue right now. Nobody's drilling and there's no incentive to drill because management's no longer compensated on production growth anymore. They're compensated almost purely on free cash flow growth. So in terms of energy cycles, this time it really is different because management compensation structure has changed. So even though we've seen persistently strong crude prices, we've seen no production growth for that reason because there's a disincentive there for management teams to grow production. So it sets up an interesting dynamic this time. And then in the healthcare space, we ended up moving on from our position in Merck and our position in Dexcom. Both remain good companies. It just seems like there was some rotation inside of that sector towards some of the beneficiaries of these GLP-1 drugs, which I think it's timely to discuss now. So I'm sure many on the call have heard of Ozempic. The class of drug that Ozempic is called a GLP-1 receptor agonist. It's been used for many years to treat type 2 diabetes. What was observed is that in individuals who are taking this drug, which is a weekly subcutaneous injection, they were losing a lot of weight. So doctors started to prescribe this type 2 diabetes treatment off-label for treatment of obesity. What we've seen recently is that Novo Nordisk has gotten approval to start to market a specific obesity treatment. So that's called Wegovy. Right now in the pharma space, there are two large companies with drugs in the market. There's Novo Nordisk, which has a compound called semaglutide, and that's branded Wegovy for treatment of obesity. It's branded Ozempic for treatment of type 2 diabetes. And then there's Eli Lilly, which is one of our bigger positions. They have a molecule called tirzepatide, which is branded Mounjaro for treatment of type 2 diabetes and is in the final stages of approval for treatment of obesity. So there's not a name for that drug yet, but it is coming soon. It should be coming very soon. That's part of the reason why we like that position is it's very catalyst rich for the rest of the year. It's specifically timely to speak about this drug, these classes of drugs right now. At the beginning of last week, we got the results out of a long-term study that was done by Novo Nordisk to show the cardiovascular benefits of these drugs. So it was a 5-year study with over 17,000 participants. It was all individuals over the age of 45 that were overweight or obese and had a history of heart conditions. And what was observed that individuals who actually took Wegovy versus the placebo group had a 20% decreased risk of a cardiac event over the 5 years. So it's really positive. Only 15% decreased risk was expected. So it really blew the doors off expectations as well. And so, it's good for the participants of the study and users of Wegovy, yes, but we specifically are excited about that result because it increases the probability of widespread insurance coverage for these drugs, because they can be pretty expensive. In the US, you're probably looking at $1,000 a month to get access to one of these drugs with no insurance coverage. So widespread insurance coverage would really expand the total addressable market for these companies. So yeah, as I say, Eli Lilly's been one of our favorite exposures in the space. They're catalyst rich. They also have an Alzheimer's treatment that's working its way through the pipeline. It's currently in phase 3. The approval of the obesity drug of tirzepatide is coming over the horizon. And so we're excited about that. It's a large cap exposure. There's been another way that we've got exposure to the GLP-1 drugs, and it's a little bit counterintuitive. It's also smaller on the cap scale, certainly, and further out on the risk curve, definitely. So it's not suitable for everyone, but that's through ownership of Weight Watchers. So it's been around for a long time, obviously, and maybe just to tell the history of that company slightly. So obviously relying on in-person meetings, COVID did a number on the company. They weren't able to meet in person. They started to run virtual meetings, and that's actually how they ended up finding their new CEO. She came on about 1.5 years ago. So she had been running a virtual communications platform inside of a large video game developer. So it made sense for her to join Weight Watchers. She was looking for a CEO role. She had done the Weight Watchers program, had success with it, so it made sense. She came on, and really when she came on and became the CEO of Weight Watchers, now we had these obesity treatments come over the horizon, which really is an existential threat to the company. If you can take a weekly injection and see results, you're probably not going to want to go to the meetings, count your points, do the Weight Watchers program. But she did something that we think is pretty smart, made an acquisition of a small telemedicine company called Sequence. So Sequence is a telemedicine platform that offers prescriptions to the GLP-1 drugs. So they offer Ozempic prescriptions. And it's going to be an exciting thing as Weight Watchers starts to market that to their existing client base. So it's still really early for the company, but the stock has moved pretty well. There's still not much information out on Sequence subscriber growth. Actually, when the company reported earnings last week, what we learned was the core business, so the legacy Weight Watchers business, which is still a quality business, it's subscription revenue, so it should be ascribed a high multiple, was stronger than expected. And Weight Watchers ended up guiding down for Sequence revenue, which we think is okay. It's actually a supply issue. These drug manufacturers can't make enough of the GLP-1 drugs to satisfy supply right now. So the outlook for Weight Watchers we think is good. I'll give one more number before wrapping up, just to give an indication of the size of the market. So Eli Lilly with their type 2 diabetes drug Mounjaro, when they reported earnings last week, we learned that versus Q2 of 2022, so a year ago, they did $16 million during the quarter of sales of Mounjaro. That grew over the course of the year to $978 million during the second quarter of 2023. So explosive growth, and they're supply constrained. So the true demand is much bigger than that. So we're excited about the space. It's, it's independent of Chinese economic data. It's independent of commodity moves. It's independent of overexposure to technology. So it's a novel exposure that we're excited about. We think the demand's really good for these drugs, and those are the two companies that we've chosen to seek exposure to. So with that, I hope that's helpful. Maybe I'll pass it back to Pamela and see if there's any questions for us.
Thanks,
Thanks
James.
so much, James, and thanks so much, Diana. We appreciate your time and really loved getting an opportunity to have you present. It's always amazing for our clients to have direct access to our portfolio management team and the trading desk through you guys. So appreciate your time. And of course, doesn't look like we have any questions this afternoon. So with that, I thank you guys again. David Burrows will be back again next week, same time, same place. Thanks so much, everyone. And we wish you a pleasant evening. Have a great day.
Thanks, everyone.
Thanks, guys.
Thank you.
Bye.